So with that, I will turn it over to Rich, who's going to talk about the practice sales market in Q3.
Thanks, Win, and appreciate the introduction. And I want to welcome everyone and thank you all for taking some time to listen tonight. Lots of things going on in the veterinary market. And I like to always start high level. We'll talk about what's going on in the US and the world economy, tariffs, interest rates, peace, and other things that are happening. Then we'll move into the veterinary services market specifically, which has been resilient, but we are starting to see some cracks. We will talk about deal structure and some of the trends we're seeing on how buyers are looking at practices and how they're structuring deals. I think this is the first government shutdown where the stock market is hitting new highs during the shutdown, which sort of tells you that the business community, the economy, sort of just shrugs off government shutdowns. Like it's happened so many times in the last 15 or 20 years. It's really just viewed as sort of part of the politics of things. And I think part of the reason that it hasn't been solved quickly is that the market's not really reacting to it. Everyone expects tariffs to raise inflation, and you get this quandary if you have a slow job market, but rising prices and inflation, what should the Fed be doing? And while inflation has been inching up the last couple of months, the real impact or the negative impact of tariffs on inflation really hasn't been that bad. I think one of the things that's puzzling the Fed and many economists, me as well, is standard economic theory says when you create this uncertainty and have higher and higher tariffs, it should lead to inflation and higher prices. We're just not really seeing it that much. And I think the thing that has surprised certainly almost all the Democrats and many independents and economists is that the stock market seems to be thriving and doing really well despite uncertainty in policy, high tariffs, and a slower labor market. And so something's going right. And I think one of the things that has driven the higher stock market is the one big beautiful bill, as President Trump called it, that was passed, and that had a lot of tax cuts in it. It kept the tax cuts that were in place from expiring at year end. It created more certainty on tax policy, and lower taxes does lead people to spend more and create more investment. And when you have invoice declines, you might think that values of practices might decline. The reality is valuations have held strong and even gone up recently. And I'll point to this spike here in 2021 where valuations peaked during COVID. And then as invoice growth slowed and the economy slowed post-COVID, we saw what you would think. Valuations came off the peak of 15-ish and they went down to 11-ish at the end of 23. Now, despite the invoice declines continuing, we actually then came off this trough and started seeing valuations go up throughout all of 24 and the first half of 25. What's happened in the last 3 months, we've seen valuations flatten a little bit. I'm not placing a lot of weight on the last 3 months because we only had a handful of deals closed, probably 5 or 6. And buyer diversity is driving valuation. So this year, 2025, we've sold to 14 different buyers. And buyers change over time and who's active, who's not active. So understanding what's going on in the market, who's active, who's not, really critical when you're getting advice on selling your practice. With the 14 different buyers we've sold to this year and over 30 over the life of Ackerman, that we know that there are a number of smaller and mid-sized buyers who buy and look at practices regionally. And so depending on where you are geographically, the set of buyers will vary. Like the economy has cycles, the industry has cycles, you have enough time to ride it out. But if you're thinking of doing something sooner, we're recommending you do it sooner. So with all that said, what are we seeing with deal structures. So in 2025, we're seeing less cash and more structure versus 24. There was a lot of cash. We're not still not sure why in 24, but upfront cash is sort of regressing back down to levels we thought saw in 22 and 23. 24 seems to be an anomaly. And buyers are what we call de-risking their deal structures by offering you and sellers equity in the parent company, notes and earnouts and joint venture structures. So no one's getting all cash at close. There's some structure around the high multiples that you're receiving, being viewed more and more as a way for buyers to de-risk the multiples and the pricing that they're paying. We then saw 3 straight years of about 43% of our deals being joint ventures. That's jumped to 48%, will probably be north of 50% by the time the year ends. And so that alignment of incentives is happening more and more. As valuations have edged up this year, more and more groups are offering and sort of insisting on buyers taking some top co-equity. That de-risks the deal for the buyers. At the highest level, like the economy is in more flux than I think we've seen in a long time. It's creating uncertainty in the economy. Fed's lowering rates because the job market has softened and tariffs are a big overhang. Valuations had been going up. How long will that last? Nobody knows, but I'm hopeful it continues. And if you're thinking of exiting, we encourage you to look at it soon before the market does soften.